Okay, welcome to Chapter 16. We will be looking at cash flow activities on a cash flow statement. We'll be preparing a cash flow statement doing the indirect method, and that's pretty much it. We're going to skip a lot of stuff in this chapter. Alright, so let's talk about the statement of cash flow. Basically, we're looking at the inflows and outflows of cash for a period. This will help show abilities how a company can generate cash from operations, how it can maintain and expand its operating capacity, and to meet its financial obligations. So we're going to be looking at these statements in order to hopefully give a glimpse into our cash flow. Do we have enough money? Would somebody be willing to loan us money? It's just a guide for cash flow. There are three sections of a cash flow statement. The first one is operating activities. The second one is investing activities. And the third one is financing activities. And we're going to look at each one of these. Now, don't get confused, because in the last several chapters we've been talking about making investments. Stocks and bonds and notes and all that stuff that we've been talking about are now in the financing section instead of investing, and I'll explain a little bit more in that later. Okay, so here's a few things, like in the operating section: cash flow, cash receipts from sales, cash payments for sales, just those every day-to-day type activities. In the investing section, this is going to be like buying and selling assets. Bought a building, sold a building, bought some land, sold some land, all those different kinds of activities that deal with just your assets. And then financing is going to be stocks and bonds, dividends, treasury stocks, and there's going to be inflows and outflows from all types of those different things. So here are some more operating outflows. Those are kind of your day-to-day type activities. And we're going to be using the indirect method to report these. And there is a direct method, but we're only going to be covering the indirect. And basically what we're going to do is we're going to take our net income and adjust it down for different things, and I'll explain each of those as we go through. Okay, so investing, like I said, selling or buying a fixed asset. Financing, long-term debt, stocks, bonds, dividends. And there's going to be some things that are not cash related at all, and we'll put those on the bottom of the cash flow statement. Alright, so this is we're supposed to decide, is it an operating, investing, or financing activity? So the purchase of patents. Patents are an intangible asset, so those will be investing. Dividends, anything to do with stocks, bonds, dividends, treasury stock, those are all going to be financing. Selling or disposing of equipment, that will go in investing. Cash sales, operating. Treasury stock, once again, that's a stock type item that goes in financing. And the payment of wages expense is going to be operating. Okay, we're going to be looking at different accounts. We're going to be looking at how an asset changes the way your cash flow is, even though it's not dealing with cash. So, for example, like accounts receivable, if somebody's paying on their bill, there's going to be an inflow of cash. So, if accounts receivable goes down, then somebody must have paid you. This is an income statement, and some of the numbers on this will be pulled into the other cash flow statement. So, I'm not going to spend hardly any time looking at that. That is in your textbook for you to view. Here's a balance sheet. And we look at how accounts have changed. For example, I was talking about accounts receivable. We went from $65,000 to $74,000. So it looks like somebody charged more, probably not paid. All right, this is the heart of all the exhibits. This is the best one I have for you. I use this actually in a lot of other classes too. So you're going to start with your net income. That's the first thing. And then you're going to adjust for certain things. Step 1 is highlighted. Depreciation and amortization are always added. If it is in black, you are going to add it. Depreciation, amortization, always added. Step 2, losses will be added, gains will be subtracted. So it's almost like a backwards way of thinking. So losses added, gains subtracted. So if it says on the disposal of an asset. So if you sell a piece of land and make money, that is a gain. You will subtract that off. All right, and then you have changes in current operating assets and liabilities. If it is an asset, and this is the first part of that, if you have an asset and it increases in value, so accounts receivable, if it increases, you will subtract it. So you're going to do exactly opposite of what makes sense. If it is an asset and it decreases, you will add it. So you do exactly what doesn't seem logical. Now liabilities, such as accounts payable, if it increases, then you will add it. If it decreases, you will subtract it. And most of the time people feel like that makes a little bit more sense to them. And then you just kind of add and subtract down through there. So once again, your net income, depreciation, and amortization are always added. Losses added, gains subtracted. And then if you're an asset, you do kind of what doesn't seem logical or what seems opposite. And then with liabilities, you do what seems to make sense. And this is kind of just a repeat of those items. Okay, so let's take a look at this. Accumulated in depreciation increased by $12,000. Depreciation is always added. Okay. $3,400 of patents were amortized. Patents are an asset. Amortization of any asset is always added. There were no purchases or sales. In addition, the income showed a gain from the sale of land, so gains are always subtracted. And that's the cash flow from operating. Now that didn't include any accounts receivable or accounts payable. We'll look at that in just a minute. Now this, like I said, is just another really good view. Depreciation, add that in. Gain on the sale of land, we got that from the income statement. Gains are always subtracted. You do opposite of what seems logical. Now on the income statement, we're going to say, okay, let's look at our assets, usually just accounts receivable and inventories. We'd go in the operating section, lands and buildings and that kind of thing would end up being more in the investing category. And then look at our accounts payable, accrued expenses, income tax payable, that type of thing. All right, so we're going to be, we figured an increase or a decrease over on that very far column, 9,000, 8,000, and so forth. So once again, here's kind of an explanation of that. The $9,000 increase is deducted. This is because $9,000 increase in accounts receivable indicates that sales on account were $9,000 more than the cash received. So if your accounts receivable is going up, then people didn't pay you, so that's less cash. So increases are subtracted. I'll let you read through those. Okay, so here's the final product of the operating section. So an increase in accounts receivable, we're going to subtract $9,000. A decrease in inventory, remember, if it's an asset, you do the opposite of what seems logical. So we decrease, we add. Decrease, now this is accounts payable, so it's a liability. If you decrease in a liability, you subtract. If you add, or if you have an increase, you add. So that part's the logical part. So decrease in accounts payable, subtract. Increase in a payable, add. Decrease in another payable, subtract. And when you do all the math from that, you get your cash flow from operating. And the operating section is the most difficult. Okay, so here's another example. You can see that accounts receivable went from 4,900 to 6,500. You kind of have to watch your dates too. I went from 4,900 to 6,500, so that's going to be an increase, so we will subtract the difference. Another example, depreciation is always added, losses are added, increase in accounts receivable, an increase, we do the opposite of what seems logical, we're going to subtract. A decrease in accounts payable, to liability, we do what seems logical, so we subtract a decline. it says since dividend payments are a financing activity, the dividends payment will be reported in the financing section. So you kind of have to learn what's in each section. Stock is a financing activity. Bonds is a financing activity. Purchase of lands and buildings, those are investing activities. And it could be going the land. Okay, so we sold the land, we'll put that in the investing section, and the gain on it goes in the operating section. So that actually kind of goes in two spots. Purchased land, $125,000. Later in the year, the company sold a different piece of land with a book value of $165,000 for $200,000. How does this affect? So cash receipt, we sold the land for $200,000. We purchased the land for $125,000. That will all go in the investing section. The gain on that will go in the operating section. And remember, gains are subtracted. So this is a cash flow statement. All those things that I was just going through are shown at the top here. The cash flow from investing, don't make that hard. If you sold something, that's going to be a positive number because you have cash coming in. You're going to subtract off any cash going out. Financing, same thing. Cash coming in from the sale of stock minus the cash paid out for other things. You're just going to do your math, and that ending balance there should match what your ending cash balance is. If you have any questions, as always, let me know.